It's time to position for the coming rebounds in these three tax-loss selling stocks. These tax-loss selling stocks will flip from red to green once we enter 2024. British American Tobacco. British American Tobacco is in much better shape than most investors might think. Hormel Foods. Hormel has positioned its portfolio to appeal to younger and more health-conscious consumers. Dollar General. The discount retailer will shine again as consumers look to stretch their shopping dollar. Let's dive in. Here are the three stocks facing tax loss selling that will see a 2024 rebound. Welcome to Timely Investment Research. It's that time of year. Many investors are looking for stocks to sell for a tax loss. After all, the stock market as a whole has rallied sharply in 2023. Active traders likely have considerable realized capital gains on their books. These can often be offset for tax purposes with the sale of securities at a loss. As such, in the last month or two of the year, we often see stocks that are already downslide some more as folks rush to lock in losses to lower their tax liabilities. This is all logical and makes sense. But selling a stock simply because it is already down might not be logical aside from the tax considerations. In fact, oftentimes, the best bargains are found in these tax loss stocks that are temporarily depressed by this sort of trading, which is detached from a company's fundamentals. As of this recording, all three of these tax loss selling stocks are down at least 25% year to date, but retain bright long-term prospects. This makes it a great time to pick up these three currently out of favor tax loss stocks, which should come roaring back in 2024. Number 1. British American Tobacco. British American Tobacco is one of the world's leading tobacco companies. While the company's core cigarette business is in decline, nicotine is more stable than investors give it credit for. British American has leading offerings in categories such as vaping and heated not-burned tobacco products. British American Tobacco stock had been under pressure this year due to rising interest rates. Investors value British American Tobacco's dividend yield less when risk-free bonds offer a high return on capital. Additionally, British American Tobacco has a large debt load, and thus persistently higher interest rates would cost the company over time. The selling accelerated recently with British American Tobacco taking a large write-down on its legacy cigarette business. That's not too surprising, though, as management has made clear that cigarette alternatives are the company's future. And it is a bright one. The company is continuing to grow both revenues and earnings. Investors should look to the future, not the past, and realize that British American Tobacco is a robust business that will last for decades to come. In addition, shares currently yield an amazing 9.7%. Number 2. Hormel Foods. Hormel Foods is a leading packaged foods company. It has prioritized the production of protein-rich foods and today offers a wide array of packaged, prepared, and deli meats, pepperoni and bacon, meat snacks, nuts and nut butters, chiles and beans, and prepared guacamole and Mexican salsas. While Hormel may be famous for its SPM canned meat, that product is just a tiny piece of Hormel's portfolio today. Hormel stock has gotten hammered over the past 18 months. The price of livestock and other raw inputs soared during the pandemic along with Russia's invasion of Ukraine. Hormel didn't raise prices on its goods enough to offset the input cost inflation, resulting in a temporary drop in margins. Hormel also gave its employees a large wage increase to avoid strikes or other instability. Investors saw the slumping margins and dumped Hormel Foods stock. Rising interest rates didn't help matters either, as defensive companies like Hormel hold less interest when risk-free bond rates are elevated. However, all these factors are now turning back to Hormel's favor. Commodity prices have rapidly retreated in recent months. Labor costs should be stabilizing as the job market shows signs of cooling off. And interest rates have rapidly retreated over the past month as inflation fears start to abate. All this should set up a tremendous rally in Hormel shares in 2024. Number 3. Dollar General. Dollar General is a leading discount retailer. As the name would suggest, it offers its customers a strong value proposition, with most products selling for $1 or other similarly low price point. The company has enjoyed tremendous success over the years. It has grown to more than 19,000 locations in the United States alone. Oftentimes, Dollar General builds its stores in rural locations where there is little competition, giving it something close to a monopoly over its immediate service area. Dollar General's long-term upward trajectory hit a major bump in the road this year. Shares dropped as much as 50% from the recent highs as the company struggled with keeping its employees content and managing its supply chain in the shifting post-pandemic landscape. However, much of the fall in Dollar General stock was simply due to overvaluation. Dollar General was trading above 20 times earnings and as high as 25 at times in recent years. That's a steep level for a discount retailer. Dollar General stock is down a more reasonable 14 times trailing generally accepted accounting principles earnings today and is back on track, with recent earnings topping expectations considerably. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.